Hi everyone, Leon Williams here with Luca Financial Services and the New Start family of companies coming to you with this edition of the Financial Moment. Today I'm going to talk about a dirty little three-letter word, and that word is AMT. Remember the old tagline from the show Lifestyles of the Rich and Famous is Robin Leach, wish us all champagne wishes and caviar dreams? And sure enough, these days more and more people have the trappings of the rich. But are those trappings the new home? Is it the shiny BMW or more vacations? No. In this case, those trappings means getting hit by the alternative minimum tax, or AMT as we call it, which, by the way, was originally designed to hit only the ultra wealthy. It's not really the you have a right feeling most people had hoped for. Now, that nasty AMT isn't just for the wealthy anymore. In fact, it's trapping an alarming amount of middle class, especially those who own homes and live in states with high income tax rates. And it's getting worse. Pretty soon, over half of those incomes between $75,000 and $100,000 will be victimized by the AMT. So what's the scoop with AMT, and what do you need to watch out for? The AMT was first enacted nearly 40 years ago, and it was enacted to ensure that wealthy taxpayers pay at least some federal income tax versus sheltering their entire income with big tax write-offs. This strategy worked at the time, but AMT has never been indexed for inflation, which has resulted in more and more middle-income taxpayers owing the additional tax. All of us go through the AMT test each year. Every time your CPA or your tax preparer does your tax returns, your income is matched up with the tax bracket it falls into, and the tax owed is calculated. But we also go through a second calculation, that AMT calculation. Many deductions are eliminated and the tax brackets are reduced. The tax owed under AMT is then compared to the tax owed under the bracket calculation. And guess which one you owe? The higher tax, of course. More individuals will pay the higher AMT tax since it does not allow deductions such as certain interest on home loans, property taxes, state and local income taxes, standard deductions or personal exemptions for children and dependents that are normally deductible under the regular tax brackets. And as I stated earlier, certain interest on home loans will be wiped out under the AMT. Now, there are two types of home loans that can be eligible for tax deductibility. First, there is acquisition debt, which allows interest to be deductible on a loan used to acquire or improve your primary or secondary home, with a loan limit of $1 million. The good news about acquisition debt is that it remains deductible even if you are subject to AMT. This makes acquisition debt very valuable, but once you pay off or reduce the balance of your acquisition debt, it is gone and only the interest on the remaining portion is deductible. So taking out a new loan at a higher amount will not give that precious acquisition debt back. Most people kill their best friend by paying off their home loan in the process. The next best thing to acquisition debt is home equity debt. Home equity debt has a limit of $100,000, which can be used over and above the acquisition debt balance. The home equity debt is flexible, and you can pay it down, you can pull it back out, which is not allowable for acquisition debt. But home equity debt is eliminated under AMT. Can I hear an ouch? And with so many people being trapped by AMT and also having loan amounts higher than what was used to acquire the property, the loss deduction can be significant. It's always good to check these things with a tax professional about your own personal scenario and learn how that impacts you. And if you need a referral to a tax professional, I'd be more than happy to make a suggestion. Just give me a call. If you would like to comment, send this video to a friend, or subscribe to this video, just click on one of the buttons to the left. Thank you for this edition of the Financial Moment. Have a great day, and we'll see you soon.